Good day, folks. Today we're going to take a little look at the inventory, cost of goods sold, and non-recurring items, both from an accounting perspective, but more importantly from a financial statement analysis perspective. The first thing is that we have inventory is an asset reported on the balance sheet, but it has a direct impact on the income statement. When we look at inventory may have the following components. Raw materials, that's materials such as coffee beans or raw steel that hasn't been processed into a product yet. Then there is work in process. That's under production, the next steps. They're in the process of taking this raw material and converting it into a product. So they've added value, oftentimes it's labor, and it ends up then the final category is finished goods. Completed product ready to be sold. Now, a lot of companies have these, but from a disclosure perspective on the face of the financial statement, you're basically going to find the inventory as a number. It may break it out if it's material, and it's generally in the footnotes. But you should know this is what it's made up about. Why does that sometimes become important? Is that with inventory, sometimes you have different levels of velocity or speed of turning the inventory components into cash. The biggest thing you have is spoilage or obsolescence may reduce the value of that inventory. So in other words, the value may not be there. And a lot of that, if you think about a grocery store, they have product that is going to spoil, and that has to be taken out of inventory. It becomes worse, less and less. Same thing within manufactured products or retail. When I was an auditor, I was in Elmira, and we were visiting this manufacturing plant that made a form of exercise equipments. I think they were treadmills or something like that. And we had to observe inventory. That's one of the things accountants do, is observe inventory. A tremendously exciting thing to do in the field of accounting is watch people count. And we were in the warehouse, and on this top shelf, there was all this stuff up there. And so the guy taking them, I said, well, what is all that up there? He said, oh, that's the stuff that's been there for years. I said, oh, do you go up and count it? And he said, sometimes. I said, can we go up and count it now? And we went up. There was about 2 inches of dust on the product. So that had very little value, but yet it was carried on the books at its full value, at a finished goods. So we often have obsolescence, okay, that it doesn't sell. And that's normal course of business, but that's always a question, is what is the value of that inventory? You need to be aware of that. There are 3 essential ways of measuring inventory. First in, first out. That means it came in. The first item that came in is the first item to go out. So it assumes a somewhat normal flow. And that's used by many companies. It actually makes more logical sense. Then we have specific identification. So if you have a bigger item, say you're an auto dealer, you have the inventory that you have of cars is by specific identification. With you get into bigger items, that tends to be there. First in, first out are commodity type items. That include foods, materials, all that stuff. But specific identification for big things such as cars and tanks and all that. And then last in, first out. That's an interesting concept. However, and that is the last saying, is that you take the current inventory price, whatever came in, the price of the product, and that goes out. So what you end up having is your income statement reflects the most current cost of that product as opposed to the earlier one. Now, when we look at this is where the difference between accounting standards between the U.S. and IFRS comes into play. Very specifically, IFRS does not use the use of LIFO, last in, first out. The U.S. GAAP does allow it. Okay, so we should know that if we're looking at statements, they could portray two competing businesses very differently. In the U.S., the LIFO method is really from a tax perspective or policy perspective. And they said, okay, they say to companies, you can use LIFO, however, you have to use it for financial reporting also. So that's sort of a catch-22, because generally there is a tax benefit to you of using LIFO. But it also says that you can do that as long as your financial records are kept that way. So you have that without a change in IRS rules. Eliminating LIFO from U.S. GAAP would in fact limit its use for tax purposes. So we need to know there's that gap. There's a few other things that come into it that happen with GAAP, and as a result, LIFO may distort the fair value of the inventory. The reported value may not be the current or the fair value, okay? Because you have to use it as prices are going up or down. The other example of that is between Boeing and Airbus. In U.S. GAAP, what Boeing is allowed to do is to accumulate all the cost of developing the plane, okay? And that is in an inventory or a fixed asset account, and they amortize that or allocate it to each plane sold. So if it costs $1 billion to develop a plane, and they build 1,000 planes, that would then mean it would be allocating $1 million to each plane. But that would not be recognized until the plane is sold. Airbus, on the other hand, doesn't do that. They can't do that. Similar thing, difference between GAAP and IFRS, that what you would then have is they need to expense that. So we have to, when we're comparing international companies, we have to look at the accounting. Oftentimes inventory is one of the bigger ones. Income statement impact of inventory. The simple equation, if you start out with $1,000, you have $8,000 in purchases, you have $9,000 available for inventory. And if you have an ending inventory of $2,000, the purchases that goes to cost of goods sold is $7,000. So our valuation comes in here and in here. So that's the flow that goes between the balance sheet and the income statement. Seeing that connection can help you better see things. We move to the cost of goods sold, since we led to that through inventory. When we look at cost of goods sold, oftentimes the purchases is probably one of the bigger pieces. Cost of goods sold includes the direct cost of producing the product or service. So we segregate things out to the direct cost of production, and then we look at other categories such as general and administrative expenses. We look at research and development and non-recurring or special items. So we should know that as we're moving to the analytical side, what goes in and what does not. Now, not all companies include the cost of goods sold. Airlines, for example, do not break it down. It's more of a tradition. Oftentimes, if it's a service business, it's harder to break that down, nor is it as meaningful. When we look at what goes into cost of goods sold, I'd suggest to you, and this probably goes back to 270 for those of you who've taken it, but there's two types of cost in our cost of goods sold. Variable. These are the ones that have a direct relationship to the revenue. So think about it in the case of GENESEO coffee roasters, they sell roasted coffee beans. The raw material is coffee beans. So if they produce more, if they sell more coffee beans, volume basis, we're going to see an increase in that cost of goods sold. It's going to move up and down relative to our volume indicator. And remember, that's what you computed out. So these are variable costs that are going to go up and down. Then there are fixed within limits, plant and equipment. So if I have GENESEO Coffee Company, if I have a coffee roaster, and it's a matter of how much I'm using it. So that's going to be fixed over a given volume level. that's when we get into utilization levels. In addition to plant and equipment, we have cost of supervisors. They may be able to supervise a couple extra people without incremental cost. So we need to think about this in those two concepts. Now, as we keep going on the analytically side, we would like to start. This is where the common size comes in. We look at the common size and identify changes in the cost of goods sold or gross margin. You could do it either way. They're very interchangeable. If it remains constant, you don't really need to focus on it. You can move on because it's telling you there's a direct relationship between cost of goods sold and revenue. Now, if it's changed, you need to understand why it's changing. And we're talking material changes. Okay? And this is a concept that from an accounting perspective, we don't always see that, well, what do you mean materiality? But it is important. If you have 46.7 as a margin 1 year and 46.9 or 45.9, it isn't big enough. Now, if you go from 47 to 43, that's big. 47 to 44, when there's big items. So that's the first thing. But if it has changed, you need to understand why. The biggest reason for change that you will see is this capacity issue. Did the cost of goods sold go down because you used more capacity? Did you go up because you added capacity? So if we have an equipment, we have a supervisory team, we have everything we need, it's fixed up to a certain capacity. So if I'm roasting coffee and the coffee roaster has a capacity of 10,000 beans, and that's going to be a fixed cost. That is there whether I produce 5,000 beans, 5,000 pounds of beans through it, or 10,000 at full capacity. So oftentimes when we're increasing volume, we should see the cost of goods sold, gross margin, change up to the capacity. Other times we add a new piece of equipment to produce something, and we may not be operating at capacity. So capacity is a limit to growth. What that means is that if you run your plant, your business at full capacity, 100%, that's limiting your growth. You can't go over that without making a future investment. That can be in people, that can be in equipment, all sorts of things. But it all goes back to your volume drivers. Okay, that's why this becomes so important. We get into the analytics because we're going to be forecasting and valuing future cash flows, and this capacity issue is going to be there. If there is other things, what happened and why? Did a cost increase that wasn't passed through in the form of increased prices to the customer? So what we might see as a result of the tariffs being applied, so if you're Walmart and a lot of your product comes from China and those costs have gone up by 20%, have you been able to increase the cost or the sales price by 20%? And if you think about that, there's about half of Walmart's products outside of grocery come from China, so they're going to see a decreasing margin, but at the same time, have they passed it through to customers? So we need to really dig down into that, okay, so that as we're forecasting, we know if this is going to be a transitory issue or is it going to be a permanent issue. And if you think about tariffs for a second, they may absorb a piece of the tariffs because they don't want to raise prices, but at some point that's not a sustainable business model. So they'd have to raise prices. So if you think about what the impact of tariffs are going to be if this continues, is we're going to see a lot of prices for a lot of goods in China go up. Okay, so, and that is going to impact the firm's profitability. Non-recurring items. Oftentimes, companies incur one-time expenses that may distort their underlying operations. We need to know what happened and why. And the 10K has the answers. This is about Kraft Heinz, and here is their consolidated statement of income. So they list it all out for 3 months ending 12/18, and for the year, let's take a look at what they're showing. Well, we come down: net sales, cost of goods sold, gross profit, SG&A, excluding impairment losses, and then we see two big pieces here: goodwill impairment, intangible asset impairment. So you've already gone through the piece on business combinations. So essentially, this was the downside. When they went back and they revalued that asset, intangible and goodwill, they didn't come up with an appropriate value, so they wrote it down. So we can see that that's a fairly big number if you take that in, 7 million to 8,667,000. So oftentimes they are impairment. There's other things too, and this is where you got to look very carefully as to what these are, because when we're going to go back, we're going to do something called normalization of earnings as we move forward, but we need to understand what they are. Now, in a common size income statement and in our summary income statements, we do want to break them out. So if you haven't done that, please do so. Now, what companies will also do is they come up with something called non-GAAP earnings, where they want to show you, a user of financial statement, what things would be like if certain things didn't happen. It's to make the company look better. And when you look at this, they have to, in investor presentations and 10K, they actually need to show you the reconciliation of net income to adjusted EBITDA. Now, why are they using adjusted EBITDA? It looks better. So let's take a look here. And here's their net income. This comes right from, right here, 12,668. They add back interest expense because we're looking at EBITDA, earnings before interest, taxes, and depreciation. They have operating income, still shows a loss. So they add back depreciation. You can see that coming here. Then they said there's something called integration and restructuring expenses. 296 million in 18, 606. Again, this is a big item. Now we get deal cost, unrealized gains on commodity hedges, not material. So we don't need to look at that. And here you have the big one, impairment losses. So in this case, what we would be looking at to understand is what happened here, 15,939, and the 296, to understand what they are. So in analysis, we need to find them out. These are immaterial, so we can leave them go. But when you start, it looks here that you went from income of 10.9 to a loss of 10.2. That's almost a huge number, okay? That it dropped that much. But when we come down and we add back these things here in both years, so now if it happens all the time, is it really recurring, non-recurring, or a special item? I don't know. But when you come down to it, they don't look as bad as they may appear to be. So this is what they're trying to do. Now, the accounting profession in the SEC has said, well, if you're going to do some of this stuff, you really need to disclose it. And on this screen, what you see is they're starting with fully diluted earnings per share each year, and they're adding back all of these things that we just looked at here. They're adding them all back. They added one in here that they didn't disclose, and that is U.S. tax reform. So you're going to look at the tax reform is the next topic in this series. But what they do is they go through and they have to disclose what these items are. So here in the 10K, there is a footnote. this is the integration. It tells you what it is, where it came from, and why it arose. So these are sort of some of the accounting and analytical things that as we move forward that you're going to need for your next project. Take these things into account. I've tried to identify the key things as we get into analytics. If you have any questions, please let me know.